This is so urgent. It is imperative to recognize that the current situation will have a profound financial impact on each and every one of us. By delving into historical events, specifically March 3, 1933, when Franklin D. Roosevelt faced a similar predicament, we can unveil startling parallels that warrant earnest attention. Through the study of past eras, we become cognizant of the undeniable fact that we have never witnessed a war, civil war, or found ourselves in such unprecedented circumstances. Consequently, three major factors that are currently unfolding in our lifetime demand utmost consideration: the colossal accumulation of debt, the subsequent printing of money to monetize said debt, and the reverberating effects of inflation. Approaching these factors with an unwavering analytical mindset, akin to that of a mechanic specializing in cause-effect relationships, will shed light on intricate dynamics. Inflation emerges as a direct repercussion of this process. Moreover, this crisis teeters on the precipice of another pressing issue: the intensifying internal conflicts catalyzed by populism. The left and right factions valorize their distinct ideals, which engenders a rancorous struggle. Within this narrative, populism spawns representatives who pledge to champion their supporters' cause against the opposition. This uncompromising approach disregards the vital need for middle ground and stipulates victory at any cost. Consequently, our societal landscape is fraught with an unprecedented wealth gap, opportunity disparity, and a host of other divisive issues. This volatile scenario mirrors the backdrop of the 1930 to 1945 period, and extensive examination of this bygone era becomes essential. We find ourselves embroiled in a vexing great power conflict. World orders typically emerge from a backdrop of warfare, with a dominant force dictating the rules. The United States assumed this mantle in 1945, wielding 80% of global wealth, half of the world's GDP, and monopolizing military strength. Thus, the American world order commenced, ushering in an era of prosperity and tranquility. However, the balance of power has since shifted, with the chasm between the United States and its counterparts noticeably narrowing. Consequently, a great power conflict now looms ominously over us. To gain valuable insights into this exigent matter, we must meticulously examine historical precedents that substantiate this recurrent pattern. When these three aforementioned elements converge, an exceptionally perilous environment crystallizes. The remarkable similarities to historical contexts underscore the gravity of our present circumstances. We must move forward with razor-sharp vigilance, striving to understand the mechanics at play in order to navigate this treacherous landscape effectively. By arming ourselves with knowledge gleaned from the annals of the past, we fortify our ability to confront this new crisis head-on. In the realm of finance, we find ourselves in a peculiar predicament, one where the conventional wisdom of boosting prosperity through the infusion of funds and credit has hit a roadblock. It's a conundrum of economic logic. Increasing the money supply inevitably dilutes the value of currency. The age-old axiom holds true. One man's debts, curiously enough, become another man's assets. The repercussions of this conundrum slowly manifest over time, as those entrusted with safeguarding value are left holding devalued assets, prompting them to liquidate, creating a cascade of problems. This monetary dilemma bears an uncanny resemblance to historical instances, such as the Romans' tactic of reducing the gold content of their coins. A seemingly innocuous alteration that, in its own way, catalyzed the specter of inflation. This is a stark reminder that the mere act of printing more money doesn't elevate living standards. Naturally, the question arises, where can one securely store their wealth? A currency is traditionally entrusted with two primary roles, as a medium of exchange and as a repository of wealth. However, the latter role becomes precarious when the currency in question begins to lose its purchasing power. People have long regarded cash as a safe harbor for their investments, but the eroding purchasing power of currency, coupled with a staggering 8% inflation rate over the past year, while interest rates remained in the doldrums, has cast doubt on its safety. A more pressing concern, however, is the fixation on currency exchange rates, overshadowing the fact that these currencies don't necessarily fulfill the role of wealth preservation. They serve as transactional tools, yet their viability as long-term storeholds of wealth remains questionable. Take, for instance, the European euros and euro-denominated debt, plagued by negative interest rates, a dilemma mirrored in Japan. These rates barely manage to offset the ravages of inflation. It's a stark reminder that wealth preservation requires a broader perspective than simply focusing on currency exchange rates. The challenge lies in finding a stable repository for wealth, capable of weathering the turbulent tides of economic uncertainty. In the early 1930s, during the depths of the Great Depression, a disconcerting pattern emerged. The world watched as one by one, currencies across the globe withered away, their value eroding in relation to goods, services, and other asset prices. The economic fabric was unraveling, and the common thread in this narrative was clear. These currencies were all intertwined, collectively plummeting into obscurity. They were failing as reliable storehouses of wealth. This economic turmoil prompted a pivotal realization. It was more profitable to utilize funds for borrowing or investing in assets that could preserve their purchasing power. It was a tectonic shift, and it manifested in various forms. The key lay in scrutinizing the nature of the cash one held, for this was essentially a debt instrument used as a repository of value. The litmus test was its real returns. The Federal Reserve, along with central banks worldwide, comprehended this intricate dance of economics. When inflation reared its head and economies surged with strength, they knew it was time to apply the brakes. Conversely, when the economic tide receded, they would step on the gas. However, there seemed to be a blind spot regarding monetary inflation. The world had been thrown into a quandary. Interest rates had plummeted to such depths that in many instances they had sunk into negative territory. Liquidity flowed abundantly, and the extraordinary measures taken meant that borrowers found themselves in an unprecedentedly favorable position. Interest-only loans became the norm, and dividend payments shrank to mere shadows of their former selves. The burden of repaying principal on debts had all but evaporated. Debt requirements were so easily met that companies and individuals alike indulged in borrowing. In a world where interest rates barely existed, they seemed to be getting assets for free. The world acclimated to this new financial paradigm. A paradox emerged as interest rates in real terms scraped the bottom of the barrel, languishing in the shadow of inflation. The central banks further exacerbated the situation by pumping more currency into the system. Inflation was inevitable, and it was on the rise. Mechanically speaking, this upheaval led to a colossal surge in debt, and the financial markets were structured around these abnormally low interest rates and the ensuing liquidity. The entire framework of calculations changed. What Ray Dalio is positing, as I dissect the numbers and delve into the intricacies, is that the threshold for interest rates to offer a substantial real return on debt suddenly seemed untenable. It was too high for a world that had become so reliant on the prevailing low interest rates, and it didn't align with the economic realities. As we stand at the precipice of another financial crisis, it becomes apparent that the world's financial systems are built upon a fragile foundation. The interplay between interest rates, inflation, and debt has become an intricate dance with no easy solutions. It is this dance that will define the new crisis that is fast approaching, and it is imperative that we prepare for the impending storm, for its effects will reverberate through every facet of our lives within the next 2 weeks. In the upcoming weeks, a new crisis is set to affect the lives of every individual. Renowned investor Ray Dalio has raised concerns about an impending scenario where inflation rates surpass interest rates, leading to undesirable consequences. As a result, investors are likely to opt for selling, which will have a cascading effect on various markets, particularly the stock market and the capital markets. This ripple effect implies that most assets people own, predominantly stocks and bonds, will experience a significant decline. The Federal Reserve will encounter significant challenges in this situation. Currently, they are operating with a highly restrictive monetary policy plan, evident from the supply and demand dynamics of credit. Given the substantial deficits the federal government is projected to run, they will have to resort to selling debt, such as treasury bills and bonds. Furthermore, the Federal Reserve itself plans to offload $1.1 trillion of debt. This entails that private investors, including pension funds, will experience losses during periods of inflation, eroding their buying power. Consequently, they are compelled to sell their holdings, thus creating an overwhelming selling imbalance that must be balanced through buyers. This imbalance leads to a contraction in private credit, paving the way for a recession. Analyzing the current scenario, it is evident that we are in the early stages of a tightening phase, where the effects are beginning to emerge. While short rates have not surged significantly, it is the unexpected aspects of this situation that are unfolding. The precarious trade-off between growth and inflation further complicates matters, leading me to conclude that we have entered a stagflation period akin to that of the 1970s. However, it is crucial to view this crisis in conjunction with the other prominent forces at play. One such force is the internal conflict pertaining to the availability of funds, both real and fiat. While there is an abundance of fiat money that can be printed, the scarcity of real money poses a significant challenge. The prevailing sentiment suggests that we need to allocate funds for various pressing matters, such as social conditions and infrastructure. These include initiatives like the reconstruction of Ukraine and bolstering military expenditures. Nevertheless, we often fail to address the question of how much money we actually possess to fund such endeavors. Consequently, the financial implications and costliness associated with addressing environmental concerns grow even more pronounced, primarily due to the absence of cost-effective technologies. In the realm of politics, the current landscape is intricately woven with the gears of mechanical precision. We find ourselves standing at the crossroads, faced with the looming specter of inflation, a formidable force that promises to further exacerbate the growing political chasm. This looming economic menace threatens to deepen the divide as populism takes root, and both sides of the political spectrum dig in their heels. In this tense environment, the very concept of conceding defeat becomes increasingly elusive, leaving our nation teetering on the precipice of uncertainty. The ramifications of this economic strife are far-reaching, with financial strain poised to tighten its grip. As we cast our gaze towards the horizon of 2024, we're met with a disconcerting forecast. The cyclical nature of economics alone paints a grim picture, foretelling conditions that are likely to be significantly worse than our present state. The question that looms large before us is the essence of money itself, its genesis, its digital transformation, and most crucially, its ability to maintain its intrinsic value untarnished by the whims of central banks. Integral to this discourse is the question of transferability and universal acceptance. Can this new form of currency transcend geographical boundaries, facilitating seamless transactions across the globe? Furthermore, we must contemplate its privacy. In the realm of traditional finance, gold stands as a solitary figure, a financial asset that one can possess and transport without dependence on intermediaries. As we shift our focus to cryptocurrencies, notably Bitcoin, the appeal is evident. With an impeccable track record spanning over a decade, Bitcoin has remained unscathed by hacking attempts, bolstering its credibility as a medium of exchange. However, Bitcoin, like any innovative concept, is not without its challenges. Privacy remains elusive, and regulatory crackdowns threaten its legitimacy. Furthermore, in terms of overall wealth, it pales in comparison to giants like Microsoft. Yet, it is clear that the world is embarking on an epoch-defining quest, a search for the next standard of currency. In this new era, countries will inevitably introduce their iterations of digital currencies, coexisting alongside private assets and the enduring allure of gold. Crucially, we find ourselves at the threshold of an era where the very definition of money is in flux. In this uncertain landscape, the race is on to determine the widely accepted medium of exchange and a reliable store of wealth that will guide us through the coming years.